We sense that this volatility fire is burning itself out. We may not be at the end yet, but we're closer to the end than we are to the beginning. So it's time to take a deep breath and scavenge the market, because it's opened up a lot of interesting opportunities.
So, Mike Labella, I see that you think it's time to take profits out of tech, which apparently a lot of people have been doing, and move into more defensive, value-oriented sectors of the market, like what?
Certainly things like utilities and consumer staples, which really have been unloved this year up until this month. You know, one of the things about this market correction is there's been a really large amount of sector dispersion. Things like technology down over 10% this month. Utilities are actually still positive for the month. So this is a real win for diversification. The problem is, after 9 years of this rally, most investors are really under-diversified with these more defensive sectors.
Mike, you know, they may be, I'm talking about staples in particular, they may be unloved in terms of the percentage losses, but on valuation terms, they are still very loved to the point where they are trading above the market multiple. Do staples deserve that kind of premium to the overall markets at this point?
Yeah, I mean, looking at it from a forward perspective, that's certainly true. A trailing perspective, that's not quite true. It's because we still see some of them are trading at a discount. Look, you can't be broad with this market. If we think you have to look at it as stock-by-stock basis and really take into consideration the earnings and dividend growth in these particular areas, a lot of these staple companies come with some really strong dividend growth right now, as well as a higher yield. Now, that's also been very unloved, this market. This month reminded why that's important. When growth starts to slip at this stage of the expansion, having that guaranteed 2 or 3% really brings in a lot more stability to the overall stock price.
So John, ultimately this leads us to banks, I think, who are actually giving more capital back to investors, and yet they've been crushed. And so we've maybe decided here that we can't be investing in the tech sector and in the triple Qs and the big leadership. What do you do with banks and industrials, places where they're paying you to be there for the first time? But frankly, this has been a challenging trade.
I would say certainly, we at USAA look at this closely, we would say certainly the banks look very attractive. They are starting to price in a recession. And the banks, they're much better capitalized than they were before the financial crisis. They're returning cash to shareholders. Yes, loan growth has been a little weak. Yes, net interest margins with the flattening yield curve have been a challenge. But the banks are in a very, very good position to grow slowly, return capital to shareholders, and they trade at extremely attractive valuations after the recent sell-off.